Your paycheck buys less today than it did 6 months ago. That's not opinion. That's arithmetic. While you've been told inflation is under control, silver just crossed $100 per ounce in Shanghai and stayed there. That's not a spike. That's a new floor. In New York, the same ounce trades at $34. That's a $66 premium. A 194% difference between what the East pays and what the West pays for the exact same metal. This has happened only twice before in modern history. In 1980, before silver hit $50, and in 2011, before it climbed to $49. Both times, the Eastern premium appeared first. Both times, the Western price followed months later. Both times, everyone who ignored the signal paid more later or couldn't access supply at all. So here's the question. If China is paying 3 times the Western paper price for physical silver right now, what do they know about your currency that you don't? I'm John A.G., and this is the Collapse Files. On January 14th, 2025, physical silver bars traded at 720 yuan per ounce on the Shanghai Gold Exchange. At the official exchange rate of 7.25 yuan per dollar, that's 99.31 bars per ounce. By January 18th, the price crossed 725 yuan, $100 per ounce in dollar terms. It has remained above that level for 8 consecutive trading sessions. This is not a futures contract. This is not a derivative. This is physical metal changing hands in the largest silver market in Asia. Meanwhile, on the COMEX in New York, the front-month silver futures contract closed at $33.87 on January 18th. The spread between physical silver in Shanghai and paper silver in New York is 66.13 per ounce. That represents a 195% premium for physical delivery in the East versus paper settlement in the West. This divergence is not new, but the magnitude is unprecedented in the post-2008 era. Premiums between Shanghai and COMEX typically range between 2% and 8%, driven by import duties, transportation costs, and local supply-demand dynamics. A 195% premium is not explained by logistics. It is explained by scarcity, distrust, or both. To understand why this matters, you need to look at volume. The Shanghai Gold Exchange reported 4,123 tons of silver withdrawn for physical delivery in December 2024 alone. That's 155 million ounces in a single month. For comparison, total global mine production in 2024 was approximately 822 million ounces for the entire year. China is withdrawing nearly 19% of annual global production in a single month from a single exchange. Now compare that to COMEX. Registered silver inventories, the portion available for immediate delivery, stood at 38.7 million ounces as of January 20th, 2025. That's down from 42.3 million ounces on January 1st and 46.8 million ounces on December 1st, 2024. The drawdown is accelerating. In the last 50 days, COMEX has lost 8.1 million ounces of registered inventory, a 17.3% decline. At current withdrawal rates, registered inventories will fall below 30 million ounces by the end of February. For context, a single month of Shanghai withdrawals exceeds the entire COMEX registered stockpile by a factor of 4. The market structure reveals additional stress. On January 15th, the March 2025 silver futures contract on COMEX went into backwardation for the first time since March 2023. Backwardation means the spot price, or near-term futures price, exceeds the price of contracts further out. In a normal commodity market, futures prices are higher than spot prices because of storage costs and interest rates. When that inverts, it signals immediate physical demand exceeding available supply. Backwardation in silver is rare. It typically appears during supply shocks or liquidity crises. The last sustained period of backwardation occurred in early 2023, when industrial users scrambled to secure supply amid production disruptions. Before that, it appeared in 2020 during pandemic-related shortages. The open interest data confirms tightness. As of January 17th, open interest in COMEX silver futures stood at 160,422 contracts. Each contract represents 5,000 ounces. That's 817 million ounces of paper silver claims. Compare that to registered inventory of 38.7 million ounces. The ratio is 21 to 1. For every ounce of physical silver available for delivery, there are 21 ounces of paper claims. If even 5% of contract holders demand physical delivery instead of cash settlement, the exchange cannot fulfill the obligation without sourcing metal from outside the system. That sourcing requires paying up, potentially far above the current futures price. This is not speculation. We know what happens when paper markets face physical delivery pressure. In March 2020, the gold futures market experienced exactly this scenario. The spread between London spot gold and COMEX gold futures widened to 70 per ounce as physical metal became unavailable for delivery in New York. Arbitrage broke down. The exchange was forced to accept gold bars from other jurisdictions that did not meet COMEX specifications. The problem resolved only after the Federal Reserve intervened with repo facilities to provide liquidity. Silver is smaller, less liquid, and more vulnerable to the same dynamic. The Shanghai premium is the clearest signal that physical demand in the East is outstripping the West's ability to supply at current paper prices. Chinese buyers are not paying $100 per ounce because they believe the COMEX price will rise. They are paying $100 because they cannot get metal any other way. That tells you the COMEX price is wrong. It tells you the paper market is disconnected from physical reality. And it tells you that disconnection is widening. To understand where the system is breaking, you need to understand how silver pricing is supposed to work. Silver is a globally traded commodity with multiple pricing mechanisms. The two dominant mechanisms are the London over-the-counter market and the COMEX futures exchange in New York. The London market is where large institutional trades occur, primarily between banks, refiners, and industrial users. Pricing is based on physical delivery of standard 1,000-ounce bars. The COMEX market is a futures exchange where contracts are traded for future delivery. Most contracts are settled in cash rather than physical metal. The COMEX price serves as the global reference price because it is transparent, liquid, and accessible to all market participants. Under normal conditions, arbitrage keeps these markets aligned. If silver is cheaper in New York than London, traders buy in New York and sell in London, pocketing the spread. The buying in New York pushes the price up and selling in London pushes it down until the spread narrows to the cost of transportation and financing. The same mechanism applies between COMEX and Shanghai. If Shanghai trades at a premium, metal flows from west to east until the premium normalizes. This arbitrage depends on three conditions: available supply, functioning logistics, and trust in contract settlement. When any of those conditions breaks, the arbitrage fails. Right now, all three are under stress. Start with supply. Global silver mine production has been essentially flat since 2016, averaging between 820 million and 850 million ounces per year. Demand, however, has grown. Industrial demand, primarily from solar panels, electronics, and electric vehicles, has increased from 520 million ounces in 2019 to an estimated 690 million ounces in 2024. Investment demand, including bars, coins, and ETFs, added another 240 million ounces in 2024. Total demand exceeded 1.1 billion ounces. The deficit is being met by above-ground stockpiles, recycling, and drawdowns from exchange inventories, but those sources are finite. Now add logistics. China effectively stopped exporting silver in 2023. Officially, the government imposed no export ban, but permits for large-scale exports have been quietly restricted. As a result, silver that would have flowed from Chinese refiners to Western markets is staying in China. At the same time, Western refiners are running near capacity to meet investment and industrial demand. There is no spare refining capacity to redirect metal eastward in meaningful quantities. The result, physical silver is effectively trapped in regional markets, and prices are fragmenting along geographic lines. The third factor is trust. COMEX pricing is based on futures contracts that settle in cash 98% of the time. Only 2% of contracts result in physical delivery. That works as long as market participants trust they could take delivery if they wanted to. But when registered inventories fall to 38.7 million ounces and open interest represents 817 million ounces, that trust erodes. Traders begin to question whether the exchange could actually deliver if a significant portion of contracts stood for delivery. That doubt is what creates backwardation. It's what widens spreads, and it's what drives physical buyers to pay premiums rather than relying on paper settlement. Here's who is trapped. Industrial users, companies that need silver for manufacturing, are locked into supply contracts based on COMEX pricing. When the physical premium spikes, they face a choice: accept delay and hope supply arrives, or pay the premium and lock in metal. Many are choosing the latter. That buying pressure reinforces the premium. Investors holding paper silver through ETFs or unallocated accounts face a different trap. Their claims are backed by metal held in vaults, but those vaults are not segregated by owner. If redemptions surge, the fund must source physical metal at market prices. If the physical premium is 195%, the ETF cannot deliver without massive dilution or suspension of redemptions. Retail buyers are already experiencing this. Premiums on silver coins from major dealers in the US range from $6 to $9 over spot, a 20% to 27% markup. That premium has been climbing steadily for 18 months. The commercial banks that operate as market makers on COMEX face the most acute risk. These banks hold massive short positions in silver futures as part of their hedging and market-making operations. As of the latest Commitment of Traders report, commercial traders held net short positions equivalent to 420 million ounces. If physical delivery pressure forces the COMEX price higher, those short positions generate losses. If the exchange declares force majeure and settles in cash at an administratively determined price, the banks avoid losses, but the exchange loses credibility permanently. Either outcome breaks the system. The question is which break occurs first. Let's put numbers to the divergence. On January 20th, 2025, the Shanghai Gold Exchange physical silver price was 726 yuan per ounce. The official USD CNY exchange rate was 7.24. That converts to $100, 28 per ounce. The COMEX front month futures price that same day was 33.91. The premium is 66.37, or 195.7%. This is not a single day anomaly. The premium has been above 180% for 12 consecutive trading days. The average premium over the past 30 days is 172%. The average premium over the past 90 days is 143%. The trend is clear. The gap is widening, not narrowing. Compare this to historical norms. Between 2015 and 2023, the average Shanghai premium to COMEX ranged from 3% to 12%, depending on local demand and import quotas. The largest sustained premium during that period was 18%, occurring in mid-2020 during pandemic-related supply disruptions. A 195% premium is more than 10 times the post-2015 average. It is outside any range that can be explained by normal market mechanics. Now, examine inventory trends. COMEX registered silver inventories peaked at 107.8 million ounces in March 2021. By January 2025, they had fallen to 38.7 million ounces, a decline of 64.1%. That's 69.1 million ounces withdrawn in less than 4 years. The decline has accelerated recently. In the 12 months ending January 2025, registered inventories fell by 22.4 million ounces, a 36.6% annual decline rate. If that rate continues, registered inventories fall below 25 million ounces by July 2025 and approach zero by early 2026. Obviously, the exchange will intervene before inventories reach zero, but the trajectory indicates unsustainable pressure. Compare COMEX to Shanghai. The Shanghai Gold Exchange reported total silver inventory of 1,247 tons as of January 17, 2025. That's 40.1 million ounces, roughly equivalent to COMEX registered inventories. But here's the difference. Shanghai inventories have been stable, fluctuating between 38 million and 42 million ounces over the past 6 months. COMEX inventories are collapsing. Why? Because Shanghai buyers are willing to pay $100 while COMEX participants are paying $34. Metal flows to the higher price. That's arbitrage. But the arbitrage is not closing the spread, which tells you supply constraints are binding. Now look at the ratio of open interest to inventory. COMEX open interest is 817 million ounces. Registered inventory is 38.7 million ounces. The ratio is 21.1 to 1. For every ounce available for delivery, there are 21.1 ounces of paper claims. Compare that to the ratio in 2015 when it was 12 to 1. Compare it to 2020 when it was 15 to 1. The ratio has expanded by 40% in the past 5 years. This expansion represents growing leverage in the paper market relative to physical backing. Leverage works in both directions. On the way up, it amplifies gains. On the way down, or during a delivery squeeze, it amplifies losses and defaults. Examine the Shanghai withdrawal data. In December 2024, withdrawals totaled 4,123 tons, or 155 million ounces. Compare that to December 2023, when withdrawals were 3,214 tons, or 103 million ounces. That's a 50% year-over-year increase. Compare it to December 2022, when withdrawals were 2,156 tons, or 79 million ounces. That's a 96% increase in 2 years. Chinese physical demand is not plateauing, it is accelerating. And it is doing so at a time when global mine supply is flat and Western inventories are falling. Now compare investment demand across regions. U.S. mint sales of Silver Eagles totaled 13.7 million ounces in the fourth quarter of 2024, down from 14.2 million in Q4 2023. European investment demand, as measured by allocated silver holdings in European vaults, increased by 18 million ounces in 2024. Asian investment demand, as proxied by Shanghai withdrawals and Indian imports, exceeded 220 million ounces in 2024. The East is absorbing nearly 10 times the physical silver as the West. Yet the West sets the price through COMEX. That asymmetry cannot persist. Finally, examine the backwardation data. On January 15th, the March 2025 silver contract traded at $34.12, while the May 2020 contract traded at $34.08. That's a 4-cent backwardation over a 2-month period. By January 20th, the March contract was at $33.91, and the May contract was at $33.84, a 7-cent backwardation. The backwardation is deepening. In a normally functioning market, the May contract should trade above the March contract by approximately 15 to 20 cents, representing 2 months of storage and financing costs at current interest rates. The inversion signals that spot demand exceeds forward demand, which occurs when users need metal now and cannot wait. This is the signature of a supply squeeze. This is not the first time a massive Eastern premium has appeared in silver. It has happened twice before in the modern era, and both times it preceded significant price moves. The first occurred in 1979 and 1980. In November 1979, silver traded at $17 per ounce in New York. By January 1980, it had reached $50. During that climb, physical silver in Hong Kong and Singapore traded at premiums ranging from 25% to 60% above the COMEX price. The premium appeared first. The Western price followed. The driver was the Hunt Brothers accumulation strategy, which involved taking physical delivery of COMEX contracts and moving metal into private storage. As registered inventories fell from 120 million ounces to under 40 million ounces, the paper market lost credibility. Physical buyers in Asia, anticipating further tightness, bid up premiums to secure supply. By the time the Western price caught up, the premium had normalized, but at a price 3 times higher than where it started. The second precedent occurred in 2010 and 2011. In September 2010, silver traded at $19 per ounce in New York. Physical premiums in Shanghai averaged 8%. By December 2010, the premium had widened to 22%. By March 2011, it exceeded 35%. The COMEX price followed, reaching $49.80 in April 2011. The driver was Chinese investor demand, fueled by concerns about U.S. quantitative easing and currency debasement. Between 2009 and 2011, Chinese silver imports surged from 3,500 tons to over 6,200 tons annually, a 77% increase. That physical buying drained Western inventories and forced COMEX prices higher. Once again, the Eastern premium was the leading indicator. Both cases share the same sequence. First, physical demand in the East accelerates. Second, inventories in the West decline. Third, premiums widen beyond arbitrage levels. Fourth, backwardation appears in futures markets. Fifth, the paper price adjusts upward to reflect physical scarcity. The time lag between the premium signal and the price adjustment ranged from 3 to 7 months in both cases. We are currently in month 2 of the current premium expansion. If the pattern holds, the COMEX price will begin adjusting by March or April 2025. The differences this time are worth noting. In 1980, the Hunt brothers were private actors trying to corner the market. The COMEX and regulatory authorities intervened by changing margin requirements and position limits, which broke the squeeze. In 2011, the Federal Reserve began signaling the end of QE2, which reduced inflation expectations and took pressure off commodities. Both squeezes ended because the underlying demand driver reversed. This time, the demand driver is structural, not speculative. Chinese industrial consumption, driven by solar panel manufacturing, is growing at 15% per year. Chinese investment demand is driven by concerns about property market collapse and currency diversification. Neither of those drivers is reversible by regulatory action or monetary policy shifts in the West. That makes this squeeze more durable. There is a third historical parallel, less well known but more relevant. In 1997, China began accumulating physical gold in size, quietly purchasing from Western central banks and commercial markets. The premiums for physical gold in Shanghai over London were modest, 2% to 5%, but persistent. Western analysts dismissed it as insignificant. By 2015, China had accumulated over 1,800 tons of gold reserves, and the Shanghai premium had become a permanent feature of the market. The lesson: when the East pays a premium for physical metal over an extended period, it is not speculating. It is accumulating, and it is signaling distrust in the paper pricing mechanism. The mainstream narrative around silver focuses on industrial demand, inflation hedging, and retail investor enthusiasm. Those factors matter, but they miss the second-order effect, the breakdown of arbitrage between paper and physical markets. When Shanghai trades at $100 and New York trades at $34, the obvious response is to buy in New York and sell in Shanghai. That arbitrage should collapse the premium within days. But it hasn't. Why? Because the metal cannot move. Start with regulatory constraints. China does not allow unrestricted silver imports. Import quotas and permits are controlled by the State Administration of Foreign Exchange and the Ministry of Commerce. Large-scale imports require approval, and approvals have been declining since 2023. Even when permits are granted, the process takes weeks or months. By the time metal clears customs, the premium may have shifted. That delays arbitrage and allows the premium to persist. Next, consider refining bottlenecks. Silver imported into China must meet Shanghai Gold Exchange specifications, which require 99.99% purity and specific bar weights. Not all Western silver meets those standards. Metal must be re-refined, which adds cost and time. China's refining capacity is already running near maximum to meet domestic demand. There is limited spare capacity to process imports. That creates a physical constraint on how much metal can flow eastward, even if the economic incentive exists. Then there's the financing constraint. Arbitrage requires capital. To To buy 100,000 ounces of silver in New York at $34 per ounce and transport it to Shanghai cost $3.4 million, plus shipping, insurance, and financing. The arbitrageur must front that capital for 60 to 90 days before the metal arrives and can be sold. And if the premium narrows during that period, the trade loses money. If the Chinese currency depreciates against the dollar, the trade loses money. The risk is not trivial, especially when the premium is driven by factors outside normal market dynamics. Many arbitrageurs are avoiding the trade, which allows the premium to persist. Now consider the incentive structure for those who control information. The largest commercial banks on COMEX, JP Morgan, HSBC, and a handful of others, are net short silver. They profit when prices stay low. They lose when prices rise. Those same banks own or finance major financial media outlets and research departments that publish commodity analysis. The analysis consistently emphasizes bearish factors: rising inventories, weak industrial demand, speculative excess. It rarely mentions registered inventory declines, Eastern premiums, or backwardation. Why? Because acknowledging those signals would attract buying pressure, which would push prices higher and inflict losses on the bank's short positions. The incentive is to downplay tightness, not highlight it. Regulatory bodies face a similar incentive. The Commodity Futures Trading Commission oversees COMEX. Its mandate is to ensure orderly markets and prevent manipulation. If it acknowledges that the paper market is disconnected from physical reality, it raises questions about whether COMEX pricing is legitimate. If COMEX pricing is not legitimate, the entire commodity futures complex comes under scrutiny. The political and financial consequences are too large, so the regulatory position is to monitor the situation, issue generic statements about functioning markets, and avoid acknowledging structural problems until they become undeniable. What most people miss is that the premium is not a pricing error. It is a market signal. It is the physical market telling the paper market, you are wrong. The paper market prices silver as if supply is ample, demand is moderate, and inventories are sufficient. The physical market prices silver as if supply is tight, demand is surging, and inventories are inadequate. One of these markets is correct, the other is not. History shows that physical markets eventually force paper markets to adjust. The adjustment is never smooth. It typically involves sharp price moves, delivery failures, or forced settlement at administratively determined prices. All three outcomes destroy confidence in the paper pricing mechanism. When physical silver trades at a 195% premium to paper silver, the signal is not about silver, it is about trust. Specifically, it is about the erosion of trust in Western financial markets to deliver on their claims. COMEX is a paper market. Buyers hold contracts that promise delivery of silver at a specified price. But if only 2% of contracts ever result in delivery, and if registered inventories represent less than 5% of open interest, the promise is not credible. The market is functionally fractional reserve. It works as long as no one demands a delivery. But when physical demand surges, the system cannot fulfill its obligations. This dynamic extends beyond silver. It applies to every commodity futures market, every ETF, and every financial instrument that promises physical delivery but operates on fractional backing. The gold market exhibits the same structure. COMEX gold open interest exceeds registered inventories by a factor of 30 to 1. The London Bullion Market Association reports allocated gold holdings of 9,500 tons, but unallocated claims, which are essentially unsecured IOUs, are estimated at 3 to 5 times that amount. When holders of unallocated claims demand allocated metal, the system experiences stress. We saw this in March 2020 when gold delivery failures forced regulatory intervention. The broader implication is currency credibility. Silver and gold are not just commodities. They are monetary metals, stores of value that have been recognized for thousands of years. When buyers in the East pay a 195% premium for physical silver, they are signaling they do not trust the Western financial system to preserve value. They are choosing hard assets over financial claims. That choice reflects a judgment about the future purchasing power of the dollar, the euro, and other fiat currencies. It reflects a judgment that inflation is not transitory, that central banks are not credible, and that financial assets are not safe. What breaks first in this process is not the price of silver. What breaks first is the perception that the system is stable. That perception underpins everything. It allows pension funds to hold bonds, banks to extend credit, and businesses to plan long-term investments. When that perception fractures, behavior changes. Investors demand physical delivery instead of paper settlement. Lenders tighten credit, businesses hoard cash and inventory. The velocity of money slows. Liquidity drains from markets, and price discovery shifts from paper exchanges to physical transactions, which are opaque, illiquid, and volatile. The silver market is small. Total above-ground silver inventories are worth approximately $40 billion at current prices. That's a rounding error in global financial markets. But the signal it sends is not small. It is telling anyone paying attention that the East no longer trusts Western price discovery, that physical scarcity is real, and that paper claims are not equivalent to physical possession. If that signal proves correct, if COMEX fails to deliver, or if premiums continue widening, the loss of confidence will extend to larger markets: treasury bonds, corporate debt, equities. All of these markets depend on the assumption that claims will be honored. When that assumption breaks in one market, it spreads. Silver crossed $100 per ounce in Shanghai, and no one in the West noticed. The premium over COMEX is 195%, and mainstream analysis dismisses it as a regional anomaly. Registered inventories are collapsing, backwardation is deepening, and the East is absorbing physical metal faster than the West can supply it. None of this is hidden. The data is public. The Shanghai Gold Exchange publishes daily prices. COMEX publishes inventory reports. The signal is clear. What's missing is acknowledgement. The institutions that manage Western financial markets will not admit the paper pricing mechanism is breaking, because admitting it would accelerate the loss of confidence they are trying to prevent. So they manage day-to-day, report to report, hoping arbitrage will close the premium, or demand will slow, or some external solution will emerge. But the premium is not closing, it is widening. And the reason it is widening is that the physical market is telling the truth, and the paper market is not. When Chinese buyers pay 3 times the COMEX price for silver, they are not speculating. They are securing supply because they understand that supply is finite, and paper claims are not. They are making a judgment about the future credibility of Western financial markets and the currencies those markets price in. That judgment is being made quietly in tonnage over months and years. It is not being made in headlines or press conferences. History shows that when Eastern premiums appear in monetary metals, Western prices follow. The time lag ranges from 3 to 7 months. The mechanism is always the same. Physical demand drains inventories. Paper markets lose credibility, and price discovery shifts from futures exchanges to spot transactions. We are in month 2 of this cycle. The inventories are draining. The credibility is eroding. The question is not whether the paper price will adjust. The question is whether it adjusts through orderly market forces or through delivery failures and forced settlements. Either way, the signal is already here. The East is paying $100 for silver. The West is paying $34. One of those prices is wrong, and it's not the one being paid in physical metal.